If you are retired and are looking for ways to generate extra income from your dividend stock portfolio without assuming more risk, then this is a must-watch video for you. In this video, I will explain how to increase income from a dividend stock with a specific example. I will show you how to increase stock income from 4.6% to 14.8% using a specific example for a consumer staple stock of Albertsons, the grocery store company. My name is Ron Didesco, and I am a CFA charter holder, which stands for Chartered Financial Analyst. I am a fiduciary, which means that I am obligated to act in the best interest of clients, and I do not generate any commission dollars. I am a hedged income financial advisor with bespoke TFC capital. Let's take a look at this example. If you own shares of Albertsons, the multi-billion-dollar grocery store owner and operator, then you currently receive dividend income of 4.6% a year. However, in today's strategy, I will show you how to layer on an additional income component called hedged income of 10.2%. This means that the annualized income for owning this grocery stock without assuming more risk is the sum of dividend income, 4.6%, plus hedged income, 10.2%, for that annualized income of 14.8%. Up until now, I've not been a proponent of considering Albertsons stock for client accounts. The company has a balance sheet which is not very attractive and its growth prospects are muted. The only reason to own the stock is to receive the dividend income that it pays. However, I felt that the dividend yield was previously too low to compensate for the risk of owning the stock. 1 year ago, shares of the stock were trading at $22 and the dividend yield was 3%. However, since then, the stock has fallen all the way down to its current level of $14.82, and the dividend yield is now 4.6%. The current dividend yield of 4.6%, combined with the enhanced income strategy that I will show you in a moment, leads to a position where I now think shares of Albertsons are interesting to add to certain client accounts. Now that the stock has fallen from $22 to below $15 a share, what does Wall Street think shares are worth? Let's take a look. So, Roth thinks the stock is worth $23. UBS has a target price of $20, JP Morgan, $22, RBC, $20, and Citi, $22. With shares of the stock currently below $15 a share, Wall Street analysts, for the most part, think the stock is worth between $20 a share and $23 a share, representing attractive upside. However, the outlier to the downside is Morgan Stanley, which has an underweight on the stock and a target price of just $14 per share. This means that even with the stock having fallen so significantly and trading below $15, there's the prospect the stock still could move lower, and even though you may be buying the stock just for the dividend, you may be disappointed with the return going forwards. What can you do? Let's take a look on the next slide. Here's the enhanced income strategy. Let me give you a summary and then walk you through the details. The name of the strategy is called a covered call ATM, which stands for at the money. The summary is that you buy shares at the current market price, which is $14.82 a share, and then you limit a maximum selling price in the future, which in this case is $15 a share. And in exchange for doing so, you receive extra income called hedged income or covered call income equal to $2.40 a share. This is implemented for a time horizon, which in this case is 19 months into the future. Here's how the strategy functions, and keep in mind that we, as a fiduciary hedged income financial advisor, implement this on behalf of clients. The first step is to buy 100 shares of the stock at the current market price, which is $14.82. This is at the time of implementation. Why 100 shares? Well, we'll get there in a moment, and it has to do with the option that will be sold. So, after buying 100 shares at the market price, then we go into the future, in this case, to the options market expiring 19 months into the future, which is just over 1.5 years, and we sell a call option at a strike price. One call option represents 100 shares and provides the buyer of the contract with the right to buy your shares from you at a particular price called the strike price on or before a particular date called the option expiration date. In this case, the strike price is set at $15 a share. So the strategy consists of buying 100 shares at the market price of $14.82 at implementation, and then selling one call option at a strike price of $15 a share, expiring 19 months into the future, and receiving extra income called hedged income or covered call income of $2.40 a share. This is how the strategy is actually implemented. The first step is to buy 100 shares of Albertsons, ticker ACI, at the current market price, which is $14.81 a share. The second step is to go into the options market for date in the future, which in this case is January 21st, 2028. This is 19 months into the future. This strategy consists of selling a call option at a strike price of $15 a share. Currently, the bid is $2.35 and the ask is $2.60. This means someone is willing to pay $2.35 a share for the contract and someone is willing to sell the contract for $2.60. The last trade was $2.42 a share. We conservatively estimate that the proceeds that you would be able to generate at this time for selling this option is $2.40 a share. Let me walk you through the math of the strategy, and then once this is concluded, I will show you a simplified chart. If you just want to see that simplified chart, you can just fast forward a minute or two and check that out in the video. But the details are that the covered call math consists of buying 100 shares of the stock at the current market price, which is $14.82. The second step consists of selling one call option expiring 19 months in the future at a strike price. This is your capped upside potential, or the maximum selling price, which is $15 a share. In exchange for selling this contract, you receive hedged income or extra income or covered call income from selling this call option equal to $2.40 a share. In the event that the stock falls prior to option expiration, 19 months in the future, your effective downside break-even price is $12.42 a share for the stock, which is the difference between what you're paying for the stock, $14.82, and the hedged income received of $2.40. This means that your downside break-even is 16.2% less than where the stock trades. So the stock would have to fall more than 16.2% for you to lose money on the stock over 19 months, excluding the dividends that you receive. Of this hedged income of $2.40, this is equal to hedged income of 16.2% over the 19-month investment horizon. The upside potential that you have in this strategy is simply the difference between buying the stock at $14.82 and the maximum selling price of $15 a share, which is just 1.2%. This is the trade-off for you receiving that generous hedged income of 16.2%. Your total return potential is capped for share appreciation potential at just 1.2%. The dividend income received on an annual basis is 4.6%, and allocated over this 19-month investment horizon is 7.3%. This means that the maximum potential return for the strategy is the sum of the hedged income received of 16.2% plus the maximum share price appreciation potential of just 1.2%, plus the dividend received over the 19-month investment horizon of 7.3%, for a total return of 24.7%. This is your maximum total return potential, meaning that in the event if the stock were to rise significantly, the total return potential of yours here is capped at 24.7%. However, in the event that the stock were to be unchanged over the next 19 months, instead of just generating that total dividend income of 7.3%, this strategy also generates that hedged income of 16.2%. An additional benefit is that because this hedged income of 16.2% would be generated over a 19-month investment horizon, more than 12 months, this income is classified as a long-term capital gain and taxed advantageously for you at a lower rate than just regular income. Here's what the simplified chart looks like for the 19-month investment horizon. The annual dividend is 4.6%, though over this 19-month investment horizon will be 7.3%. The hedged income received is 16.2%, and the maximum share price appreciation potential is capped at 1.2%. This means that the total return potential for the strategy is the sum of the hedged income, 16.2%, plus the dividend income of 7.3%, plus the capped upside potential of 1.2% for 24.7%. Irrespective of how much higher the shares may rise by option expiration, your share price appreciation potential is capped at 1.2%, and your total return potential is capped at 24.7%. This is the inherent limitation of the strategy, that if the stock were to, say, theoretically rise 30%, 35%, whatever the case may be, your total return potential is capped at 24.7%. However, in the event that the stock is unchanged over 19 months, then instead of just receiving the dividend income of 7.3%, this strategy generates that 7.3% dividend income plus the hedged income of 16.2%. An added benefit is that this hedged income is your guaranteed income to keep so long as you maintain this position until hedge expiration, 19 months into the future. And this hedged income serves as a buffer of downside protection in the event that the stock falls by option expiration. This hedged income of 16.2% serves as the downside buffer of protection equal to 16.2%, meaning that excluding dividend income of 7.3%, stock would have to fall more than 16.2% over the 19-month investment horizon for the strategy to lose money because of that hedged income received. In the event that you only own the stock and the stock were to fall 10% over the next 19 months, then excluding dividends, you would lose 10%. However, with this strategy, if the stock were to lose 10%, you would have an offset of this positive hedged income of 16.2%, meaning excluding dividends, if the stock falls 10%, you would lose 10% on the stock, but make 16.2% in hedged income and actually generate a profit of 6.2%, whereas if you only own the stock, then in this example, you would lose 10%. As you can see from today's example, hedged income investing can be a really powerful tool for enhancing income in your portfolio while also generating that downside protection and achieving tax efficiency. If you would like to learn more about this style of investing, go to our website at bespoketfc.com. If you would like to see specific portfolio examples for different dollar amounts and strategies, go to the top right-hand corner of bespoketfc.com and click Insights. You can also get there by going to bespoketfc.com/insights. As a reminder, today's video does not constitute investment advice. All client portfolios are customized with diversification and portfolio weights and strategies that are tailored for each client. If you would like to reach out and have a conversation to understand what might be possible for your portfolio, reach out via bespoketfc.com and we would be glad to connect with you. Thank you for watching, like and subscribe, and hopefully we'll see you next time.